Welcome to MacroHive Conversations with Bilal Hafiz. MacroHive helps educate investors and provide investment insights for all markets from crypto to equities to bonds. For our latest views, visit macrohive.com. Greetings and welcome, Peter. It's great to have you on the podcast show.
It's good to be here, Bilal.
Now, before we go into the meat of our conversation, I always like to ask my guests, and our listeners like this as well, something about their origin stories. You know, what did you study at university? Was it inevitable you'd end up in finance and in investing? And something about your journey up until now.
Actually, the origin goes back a little deeper than that.
Okay.
So when I was in my late teens, still at school, my father gave me a very small sum to invest and access to his broker. And it was the late 60s, and Bilal, that was obviously a strong bull market. And I firmly convinced myself that I must be a genius because we kept making money. So that certainly sharpened my enthusiasm for this as a route going forward. I went to Oxford to read PPE, where I had really quite exceptional tutors, as a matter of fact, but we won't go into that in detail. And that was great. And from there, went into the city, where I actually didn't know anybody. I had no contacts whatsoever. My first job was a bit of a mistake because I joined a firm of jobbers in the belief that they were what are now called prop traders. I thought that sounded quite fun, but it wasn't what they did at all. Their holding period was 20 minutes. So I quite swiftly moved on.
Yeah, and then I mean, how did you get into asset management industry? So it sounds like you started on what we call today the sell side, I suppose.
Yeah. So I moved to a firm of brokers called Myers, actually, originally, but they became Capel Cure Myers. Because I'd observed, by that time I knew something about how the city worked, having known absolutely nothing, and realized I was in the wrong bit of it. So I went into originally became an oil analyst, matter of fact. But that was, in those days, analysis was always a training ground. Hardly anyone of any seniority was an analyst. It was just how you learned. And then went on into investment management. So that worked very well. And I started running Capital Cure Trust in 1982, when I have to tell you it was fairly modest in size. The market cap was a little less than $500,000, and it was not considered one of the big clients of the firm, which is no doubt why I was allowed to run it. But
and Capital Cure Trust, what's the name? What does it mean?
So the trust, the reason why it's called that.
Yeah.
It was set up by someone who believed that equities always went up over time, and if you were geared, you got more, which turned out to be not an entirely accurate assessment. So I think it was in 74, possibly 76, and long before I was involved. The actual asset value came up as a duck egg, that the liabilities exceeded the assets. But fortunately, the liabilities were fixed for long term, so they were able to keep going. So obviously with that gearing, when markets recovered, it recovered quite quickly. But it was still, as I say, in a very modest state by the time I took it over.
And then, so over the years, you've seen different market cycles, different asset classes. So in your eyes, do you see yourself as an equity person, a bond person, or, I mean, how do you classify yourself as an investor?
Right. So our theory is everything is driven by value, number one. And the important thing is risk control. So by risk control, I mean an assessment of conditions at any one time, so that where potential returns are very high, prospective returns are high, and risk is low, then you want very long duration, because you want to lock those good returns in for as long as possible. And that generally means equities. So I am answering your question in the end. But converse is also true. when risk is high and prospective returns poor, then you want a short duration as possible. And by the time we get to so back in 82, that was all equities. We were 100% in equities. By the time we get to the late 90s, we've got equity markets that look very rich and offer poor returns. But bonds still were amazingly attractive. So you could get 4.5 real yields in government bond markets at that stage. In the US, here, in Germany, they were just wonderful. So we owned a lot of bonds, not much in the way of equities, and with proper duration, so 30-year bonds featured in the portfolio and that sort of thing. With the result that we underperformed probably for at least a couple of years compared with the go-go tech stocks in America at the time. But 2000 was fine. We were nicely up in 2000, so that was okay. And similarly, in 2008, 9, and 10, we were up each of those years. So,
and actually, your track record's quite impressive. When I looked at your returns over quite a long period of time, I don't think you've had many down years.
No. So I'm hesitating because we've actually had one down year. And
over what time period? Is that over?
That was over the first 40 years.
40 years. Okay.
So that's our last scorecard, so to speak, last year. So we had 1 year when we were down 2%, which is really annoying.
Okay. If only you'd somehow got 2.5% back that year.
Right. Exactly. So and we've done 15% compound over the full period. So that's been fine. I'm hesitating a bit now because I fear when the line is drawn at the end of March, which is not that far away as we speak, we need to make up about 4%, I think, to maintain that record. So,
okay, well, I mean, whether it's 1 or 2 years, I mean, that over compounded returns over that period of time is quite impressive. But from the sounds of things, it doesn't sound like you're like a bond person or an equity person. It's more about your philosophy of value-based trading with investing with risk control. So you're almost like asset agnostic. You're not just a diehard equity person or a diehard bond person.
Yes, and we've owned very different kinds of assets over time. So index didn't exist back in when we started in 82. The bonds were a complete surprise to me that we owned a lot of bonds, for instance, by the time we got to the end of the 90s. But that was where value was driving us, and so we're happy to be driven by that. And there keep being new things. So we've got renewables today, which didn't exist before. There are all sorts of opportunities which keep cropping up, and which we obviously assess and include in the portfolio if we think they have a role to play.
And in terms of new asset classes, what do you have any views on crypto? Because obviously that became a massive fad, or not fad, but it became very popular in the last few years, and performance has recently been more mixed. Something like that. How would you approach that?
Well, I do have a view of crypto, but I take it this is a family show, so
okay, understood.
I shouldn't really express them. But we firmly believe that crypto is an environmental disaster to begin with.
Yeah.
And secondly, has no fundamental value at all. So it is possible that it will get bid higher. We have no idea, but it's absolutely not an investment which a value player could even begin to think about. And it makes me very sad, actually, that as I understand it, the owners of crypto are largely very young new investors, I wish them well, and I hope they will sell their crypto and buy something more sensible soon.
And so when you say it has no fundamental value, does that also apply to commodities like gold? Or is there something different about gold, would you say?
Yeah. I mean, it does apply to gold. It's a very good point. there's a difference, which is that in the human brain, in human societies, gold has a history of 4,000 years of being highly valued. The construct of crypto is that there's limited supply. There's limited supply of all sorts of things, which I don't want to own either, unless they have some other attraction.
Yeah. And now, in terms of value, when it comes to, say, equities, if you start with equities, there's different types of valuation metrics. The simplest one is price earnings or price to book. Then there's cyclically adjusted, PE, CAPE, and there's always different versions of valuations.
Yeah.
How do you approach valuations when it comes to equities?
Well, we are very much influenced by CAPE and Q, which should give basically the same answer.
Yeah.
And they do. But we recognize that in different real interest rate environments, the reversion to the mean for those valuations will be more or less quick. But what we do think about the current situation is that we have moved really quite dramatically in environment. So we had 15 years when there were deflationary forces flowing from globalization, particularly China, and demographics, we're going to that, and from tech. So tech is very interesting because obviously there's always productivity improvement from technology, and has been since the 18th century. But there's a particular influence from tech over the last 15 years, which was illustrated to me by a property company. So they said their tenants in their shops could trade very happily with a cost of occupation of the shop of 20% of sales before the internet came along. And the internet has made that impossible. They've been just undercut by the internet sellers. But it can still operate at 13% cost of goods sold. And they can compete with the internet at that level. So that tells you roughly, rather helpfully, that probably 7% has been knocked off the price of all those goods sold in that way. But it's a one-off. Presumably, the internet gets more efficient, one hopes, and overcomes their problems of returns and that sort of thing. But the pace of progress is going to be very slow compared with what it has been.
And that dropped from 20 to 13% for retail. Has that occurred? I mean, have they?
Yes.
They can exist at 13%. We've reached that point, and they can survive.
Yeah. Broadly,
that's broadly,
what they are now.
Yeah.
So that would be rents and rates.
Yeah.
So both are moving down.
Okay. Yeah. And you said the CAPE and Q is a big sort of factor within there, and you then also look at real rates to sort of work out the speed of mean reversion. Now, what we've also seen over the last 10 to 15 years is the rise of these factor models. Everyone has a factor model where you systematically buy value stocks or systematically buy momentum stocks, and value indices have done quite poorly in the last 10 to 15 years.
Yes.
So that's, in some ways, it's given value a bad name. So because of that, people have said, look, value doesn't work anymore. Now, from your perspective, why, number one, why do you think, those indices haven't worked? And what's your counter to, value doesn't work anymore?
Right. So it's an interesting question. I think value does work. Okay. But,
yeah.
But I mean, plainly what has happened is that the rate of interest at which a valuer would use in a DCF has changed very dramatically. And the growth stocks, as the market calls them, have consequently had a much bigger change in valuation than the old-fashioned value stocks. First of all, I think that's going to be reversed. Well, it's hardly a great insight, is it? When behavior of tech endorses that. But second, I think it's reversed for a long time, because we've moved from this environment where those deflationary forces that I referred to have been replaced by, instead of globalization, we've got protectionism as a general characteristic. Tech is no longer the supporting force that it was. And we've got ESG. So ESG spending is absolutely essential. We need to spend a great deal on the environment. But much of it should be viewed in the same way as military spending. That's to say, you spend a lot of money, but there is no economic payback. The payback comes in the form of a better environment. And just like military spending is very inflationary, so I believe that environmental spending will be equally inflationary. Plus, of course, we've got military spending on top. So we've had a peace dividend for a very long time, and now, certainly in the West, every country is increasing its expenditure on defense. So we're in a very different environment. And I believe that it'll look very like where I started out in the late 60s and early 70s. So I'm not talking about the mid 70s. They're not forecasting mid double-digit inflation, but we will have business cycles instead of the great moderation, where whenever there was a downturn, you get a fiscal and a monetary response and prevent the downturn. But in more normal inflationary periods, you can't do that, as we are observing as we speak. Great tensions in monetary policy. And so we will have business cycles. We will have inflation that fluctuates with those business cycles, but will fluctuate around a medium, which I believe is well above the current target. Whether that target at all is maintained is a matter perhaps for another discussion.
And you mentioned the late 60s, early 70s. Presumably, I wasn't around back then, but from my understanding, at least, you had a period of stable inflation, 50s, 60s, and then you suddenly had these growing inflationary pressures. Now we look back, we all know 70s was full of inflation, but presumably the transition to high inflation, most people, I'm guessing, in the late 60s were saying it was transitory, it was temporary, nothing to worry about. Or was that not the case? Or
actually, I think it's slightly different from that. So what happened in the late 60s was that in 65, Johnson went into the White House in unfortunate circumstances, you recall.
Yeah.
And he inherited the Vietnam War, which was raging and which continued throughout his presidency. But also he had great ambitions for what we call Great Society programs. He wanted to do something for the poor. So this is when Medicare and Medicaid and those sort of programs were instituted. And he didn't feel able to raise taxes enough to pay for them. So up until the mid-60s, inflation in America had been between 1 and 1.5, pretty consistently. And there was a balanced budget in 65. But in the late 60s, the budget deficit blew out by a very small amount compared with what we currently enjoy and what we enjoyed in the 70s, but it got out to about 2.5% of GDP. But that was applied to a fully employed economy. And so demand was consistently too high. And inflation built by about 1% a year. So by the end of the 60s, it was about 6%. But here's the interesting thing. At the time, most people thought inflation was quite beneficial for equities. They were viewed as being, profits were viewed as being real. And given that, essentially we had exchange controls then, so in the UK at least, you had no alternative between equities and bonds. And nominal bonds in an inflationary environment obviously are extraordinarily unattractive. They were known as certificates of confiscation.
Okay, I like that.
Because you lose real value so consistently. So actually, the market peaked in '69 as that inflation came in. It wasn't until we got to the '70s that we understood that inflation isn't quite so benign for equities, and we saw huge falls.
And coming back to the point of equities are nominal or real assets, why shouldn't equities do well in an inflationary environment? Because surely they're benefiting from being able to raise prices. Is it
right.
that cost? The cost side becomes the big problem for them in the end, and the margins get compressed.
Well, margins did get compressed, but there's also technical things. So in '73, in '74, British corporations were on the verge of bankruptcy because they paid corporation tax on profits assessed on a FIFO basis, first in, first out. So if you bought something, cost you £1 to make, and you were selling it for £2 at the beginning of the year, and at the end of the year, it cost you £2 to make, and you were selling for £3.30. The corporation tax will be on the difference between £1 and £2, but it was costing you £2 to replace what you just sold. So the cash flow squeeze was simply fantastic, and in fact, the market in the UK was extraordinarily weak towards the end of '74, not least because the large parts of British industry were going to go bust. They had no working capital, and that was actually changed in the budget. I think we used to have lots of budgets in this, several a year. I think in the November '74, if I recall correctly, that was changed. But by then, the market had such fantastic downward momentum that it wasn't until a couple of months later, in January '75, that it bounced and doubled in a very short time.
And if we fast forward to today, then I'm not sure if this is parallel or not, but today we see profit margins actually quite large, and yes, it seems like there's been more monopolistic kind of power, concentration in various different industries. Workers are trying to assert, more power in their wages. But in a place like the US, though, you don't have unions anymore. Can there be more power to labor than capital or not? I mean, is
right,
this kind of conflict between the two going to really re-emerge?
Yeah. So I think one of the value concepts is reversion to the mean, and that sure applies to the share of GDP that goes to profits as well. So my sort of prejudice, my starting place is always going to be to look for why is it going to revert. And you mentioned one reason, which is that wages are rising very fast. Sure, unions are less powerful than they were, but the president, Biden, is making every effort to strengthen them. So if you want to participate in any of these huge programs with government subsidies, you have to have a unionized labor force. So that is helping. But the second way that wages will be helpful to people who get them, but unhelpful to corporate profits, is through the ballot box. So we have elected governments all over the Western world which have increased minimum wages, for instance, very rapidly. So here, I think next month, there's a slightly less than 10% increase in the minimum wage. And in my view, these things do not merely influence those paid the minimum wage, but the differentials quite a long way up will be impacted. So I think that with the wages, although completely agree that the very powerful unions that prevailed in the '70s do not have the same power today. Their power is growing rather than diminishing. And I expect the share of labor in GDP to grow.
And you mentioned earlier that one of the inflationary factors will be environmental spending or ESG related spending. Now in Europe, there's a big move in that direction. In the US, it's more mixed. Obviously, we have the Biden administration who use the Inflation Reduction Act in reality as an environmental, sort of form of subsidies. But the Republicans are not, on board with that. So that if there's a change of government, it may not continue. At the state level, there's big disagreement about this, or so there's much more dissent on the US side. So, I mean, do you think that the US will still engage in spending that would, reduce climate change or not?
Well, I think there's fantastic momentum to recognition of environmental issues, and so consumers play a role here, and the switch to electric cars I think we're all in favor of it, but it's not going to be cheap, and in the US, and there's an equally powerful support from the protectionism. So building all the semiconductors in fabricating, I think I should say, semiconductors in the US and so forth. I forget what the figure was, but I think Sam's were suggesting they will be 50% greater in cost there if they're built up. So I think all these things come together. It may well be that the Republicans in particular are less enthusiastic for environmental spending, but that just simply means it'll be huge rather than stupendous.
Okay, yeah, point well taken there. And your point on consumer is very, very apt and relevant as well. I mean, there's a big push on the consumer side to engage with ESG and climate change side. So now we talked about valuations on the equity side. On the bond side, how do you think about valuations there?
Well, it's very interesting, isn't it? So as mentioned, we think inflation is going to be cyclical and higher. But the consequence of the monetary policy in this, I have to say, experiment pursued by central banks for the last 15 years, I recall, I think it was Bernanke saying that the thing about QE is that it doesn't work in theory, but it does work in practice. And I think the first half of that statement is quite clear, the second rather less clear. So, but anyway, what the consequence have been, the huge misallocation of capital and these elevated debt levels, which have prevailed and which now make the economy extremely fragile. And the result of that is that there is actually quite a severe limit as to how high nominal rates can go. Certainly real rates, but I think even nominal. Because one of the lessons, having lived through inflation, about the consequences for fixed interest, is that high inflation and associated higher interest rates dramatically shortens the duration of a bond. So if you borrowed 4 years ago at, let's say, 0, the duration of your bond was the same as the maturity. But if you borrow a 10-year bond with a 10% coupon, you've got to find 10% of the value in cash of that bond this year. So it makes the appropriate balance sheet much more conservative than it was in the period of particularly of the 2010s.
Okay, yeah. And so how do you form a view then on real yields going forward then?
Okay, so we have a view on real yields, which is quite different from the rest of the world. So, as I say, I think we will get negative real yields because there have to be to sort out this debt problem over time. So that doesn't say nothing about next week. But the development of that depends on people's belief, which is, in my view, quite surprising. But there's obviously a very wide outcome to potential inflation over the next 10 years. But the market firmly believes that we have had 2 or 3 influences which have moved inflation above 2. So we've had the war, COVID, and so forth. As soon as those have gone through the system, the pig has gone through the python, we'll go back to 2% inflation. As mentioned earlier, I believe that to be very likely a mistake. So there's quite a wide fan of outcome, but the bottom of which is 2% inflation. But the break-evens in the TIPS market currently are priced to suggest that the Fed will struggle to achieve 2 on the CPI because they target 2 on the PCE, generally is about 0.35 different. So implicitly, the target for the CPI is 2.35, and the break-evens are 20 basis points below that as we speak. So I find that interesting and remarkable, actually. Maybe partly because the tax consequences for individuals owning TIPS are very unhelpful in America. So everything's taxed as income.
Yeah, and I mean, this belief by the market, as reflected in, benign break-even inflations in the long term, is that also just to do with the fact that we've been used to low inflation for such a long time? It's a habit. Like most people in the market just haven't experienced inflation. Yeah.
So if you're young, i.e., under 55, you probably have never experienced inflation as a problematic feature. So I do think it's got a lot to do with it, absolutely. And I was very struck by Larry Summers said that he'd asked the operators of the Ferbus model, so that's the Fed model for the economy in the States, to assume really absurd fiscal deficits. I think it was 10% for the next 7 years or something. What would the inflationary consequences be? And it whirled away and came out that at the end of that period, inflation will be 0.85 of 1% higher. So that's a model that's been written to produce the answer of low inflation.
Yeah.
Presumably because year after year, the richer people who operated this model found that they were overestimating inflation, so they kept tweaking it to make sure it did not consistently embarrass them in that way. So I think it makes your point really that it's fundamentally embedded not just in investors but indeed in the economists in the Federal Reserve, for instance. And I think for the reason you point out.
And I mean, what does this then mean for the financial industry? So, for example, if you're a pension company or insurance company and you have this portfolio, you're long equities, you're long bonds, you've probably allocated, especially if you're a pension fund in the US, you probably allocated a large amount to private markets, private equity, VC to get some extra return. If you're one of those types of entities, what's going to happen to them?
Well, actually, it's very interesting because just backing off a bit, we're seeing some issues with the banking system at the moment.
Yeah.
And we're seeing that because of the change in interest rate. So that the value of so-called risk-free assets, treasuries and so forth, have gone down a lot because of the change in interest rates. But of course, the real threat to banks, or a much more powerful threat in the end, is the creditworthiness of their borrowers. And so I think if one was going to pick out areas that will be vulnerable, we haven't even started a recession yet. So I mean, it's all way in the future. But obviously, commercial property will be one significant area, but also the debt associated with private equity. This is not an environment where you particularly want to be in a highly leveraged situation because recession reduces your revenues and interest rates are going up. So and perhaps as important as either of those, that the availability of credit will be much more limited. We can see now that financial conditions are really tight.
Yeah. And are you surprised how stable private equities have been over the past year or so? I mean, they, last year every single asset class, public asset class at least, fell significantly. Private equity still delivered relatively good returns.
They did on valuation.
Oh, yeah, from valuation, yeah.
So the market is telling you that it doesn't believe those valuations. So I think there's some vulnerabilities there. Of course, to speak of an asset class in general is perhaps a mistake, but there will certainly be pockets within.
Yeah.
And so you only have to look at the Bloomberg Financial Conditions Index, for instance, to see that really very suddenly it's become much more difficult to borrow in the United States. And we understand that banks like Bank of America simply will not lend to anyone who is an existing client, for instance. That's quite a dramatic change. And the availability of credit has always been the thing that causes problems rather than just the price.
Yeah. And you mentioned in terms of how you manage your portfolio, valuations, value focused, and then risk control. By risk control, in your opinion, what does that mean? Risk control.
Well, that's fundamentally is the duration point that we started off with.
Okay.
So if the duration of your portfolio is short, providing a lot of very risky assets, from a credit point of view, you're not going to get into too much trouble. So you only want to move away from that to long duration if you think you're going to be adequately rewarded for it.
And, what do you think about things like looking at drawdowns or volatility? I mean, these are kind of ways people measure risk in some ways. I mean, do you think that that's useful, or is it distraction, or how do you think about that?
Yeah, so I mean, that is absolutely the conventional way of looking at risk. And so it'd be very arrogant of me to say that it's hopeless, but we just think that the way we do it, i.e. assessing how big risks are, fundamental risks are, and the price at which your assets are offered, is a more sensible way of assessing where you are in the cycle. Are there opportunities, or do you need to batten down the hatches? I think it does work better because you can get very high volatility at the end of bear markets. Almost by definition, you've had very high volatility at the end of bear markets. And if that's your only criterion, you're going to be very liquid at the bottom of the bear market.
Yeah, yeah. And, given this change in regime that we're experiencing, low rates, low inflation to high rates, high inflation, how do you think the investment industry is going to change? Because presumably the whole investment industry and the financial sector's been built on this low inflation, low rates foundation for the last 10 to 15 years, and it's led to massive sort of passive type investment, private, all of these tech growth, all of these sorts of investments. But what's your outlook of how the industry is going to change in the next 5 to 10 years?
Okay, so the passive active bit, I'd separate out from everything else.
Okay.
I'm actually fairly enthusiastic for passive investment against most active funds because of price. And if, as we believe, real returns are going to be relatively modest over the next few years, then the cost of operating your investments becomes very critical. When you're making 15% a year, it doesn't matter if you're charging 0.5% or 1% or 1.5%. If you're making 2%, then it's either a large chunk of it or possibly even all of it, or it leaves something for you. So I think costs do become more critical at that stage. And I have to say, we in any case, espouse low cost because we view ourselves very much in a rather old-fashioned way as being in partnership with our clients. We have shared the growth of our funds with all clients, but by lowering fees. So almost every year we lower the fees on one fund or another. And Capital Cure Trust actually has a tiered level, so it automatically the fees fall as it gets bigger.
That sounds quite unusual. Is that?
Tiered fund is not
Yeah.
No, there are a few out there.
Okay.
But I think it should be the norm.
Yeah.
Absolutely.
Yeah. And in terms of your current allocations, obviously last year, most public markets underperformed. People have come into this year. There's some expectations that maybe your central banks are coming to the end of the easing cycle, so people are turning a bit more positive on risk on equities, long duration.
Right.
Maybe it's a peak in yields. So it seems like we're entering a new sort of phase, or mini phase at least. How are you positioning yourself in this?
Well, in one sense, it's much easier today than it was a year ago, because the bit that you don't have exposed to risk, i.e., things like treasury bills or very short index linked, give you a decent return, dramatically different from the situation a year ago. So the competition is greater for risk assets. They've got to produce a better risk reward than they did have to then, because of the alternative is you just do fine. In very short instruments. As I say, because we believe that valuations are still rich in equities, that profits are still high as a percentage of GDP and likely over time to come under pressure. And because we think inflation will be higher than the market believes, we are quite negative on long-term nominal rates. And nominal rates are going up are not generally helpful to equities. So we continue to be very, very underweight in these sort of risk assets. So we have about 28% in what we call risk assets, of which half is in normal equities, and the rest are things like renewables and property.
And the remaining 72%.
Right, we have 45% of the remainder is in index linked.
Okay.
Of one kind or another. We have decent amounts in treasury bills. We have credit. So I should say something quickly about credit. That a few months ago, credit seemed to offer some really great opportunities, and we bought a fair amount. We've actually been selling most of that as the spreads have adjusted to more normal levels, which have been very satisfactory. So we probably have about 13% in credit, short duration, about 18 months duration, but offering significantly better returns than treasuries, still not as good as they were. And I try to think what I've left out. A little bit of cash.
Okay, yeah. Okay, now that makes sense. I mean, that perfectly reflects your view, the portfolio you just described. And in terms of the geography of everything, I mean, is it a global portfolio, or do you focus on the specific region?
No, it's global. Again, we are drawn to areas that offer good value. So for the first time in a very long time, we've been buying some yen, for instance, because we believe the yen to be extraordinarily cheap, and not without problems of its own, but nevertheless, when things are really good value, somehow the problems don't seem to be quite as bad as when they're rather rich. So I'm very struck by the fact that Japanese wages are very comparable to Southeast Asia at this exchange rate. So a software engineer probably costs more in Vietnam than it does in Japan, which is quite a striking change.
Yeah. That's a great anecdote. Now I did want to sort of pivot back to some personal questions. What's the best investment advice that you've ever received from anyone?
The best advice, well, I'm going to give you a rather strange answer. It's an advice for life, but I think powerfully applies to investment as well. And it was when I was 13, and I was taught English by a very cultivated and quiet man called Lewis, Mr. Lewis, sir to me, as he was then. And the statement was read out that honesty is the best policy. The only time that I knew him, he raised his voice, book slammed down the desk, and he said, honesty is not a policy. And I think that is an enduring truth. The city would do better if everybody had that view. And I think it is really helpful to developing the trust on which actually capitalism should work.
Yeah.
Which I believe is rather undermined as we speak. So that's rather an odd answer to your.
No, it's a great answer. Yeah. And it makes sense. I mean, it makes things a lot more clear if you use that as your guiding light. Another question is, some of our listeners are, at university. They're going to graduate over the course of this year, and they're going to enter the jobs market, the real world. What advice would you give them?
Don't start now. No, I think that in all seriousness, I just make a couple of points. One is that now that half the population, or half of any young cohort, are graduates, it doesn't have the same distinguishing characteristic as it did when it was only half of 1% of the population.
Wow. Yeah.
And as a result of that, I think to get into the best jobs, you need to have a bit more than that, either further degree or a competency or whatever, something in addition. And the second point is rather more controversial. So I have great sympathy for a lot of people in that position, because if you want to buy a house and raise a family in London, you have very little choice but to go into a very narrow range of professions, all of which are wildly overpaid. And I'm very pleased to say. But it does raise a real question mark for those whose natural preference would be elsewhere and who will be good at things outside those professions. And I think my advice very clearly would be that if that's what you're good at, that's what you should do. Because if you don't enjoy being in the city, or being a financial lawyer or whatever, the chances are you won't be very good at it either. And won't succeed. So I think stick to your last is mine.
Okay, yeah. That's great. And then are there any books that really influence you over your career or your life in general?
Yeah. So in investment terms, there was a very interesting book a long time ago about Slater Walker. So Slater Walker was a conglomerate of the late 60s, early 70s. And Jim Slater was, I'd say, held in the same regard as perhaps Buffett is today.
Okay.
But he was not of the same caliber as Buffett. And Charles Raw wrote this book. He was a journalist. He wrote this book about Slater, which exposed the extraordinary sleight of hand that the accounts of Slater Walker and its subsidiaries represented. It just changed my view completely of looking at companies. So before that, if Ernst & Young was signed off at the bottom, I believed it. After that, I looked at reality. So it's a very had big influence on me. But other books, so John Kay writes very lucidly. So if you're going on holiday, you want a book to read about markets. So he wrote a book called Truth About Markets, and also one with Mervyn King called Radical Uncertainty. But both of them will be a great way to start.
Yep, that makes sense. I've actually had both of them on my podcast show
Right.
over the past few years, and they're both great.
They
very,
definitely are.
very sort of clear, articulate people. So
Yeah.
that's great recommendations there. And what's the best way for people to follow you?
Oh, Bilal, we have a website.
Yep.
You're not surprised to hear, which is www.cgasset.com.
Yeah.
And the important features of that are tied into LinkedIn.
Okay,
So
great. Okay.
You can.
So I can include a link on the show notes to all of those.
Right. Thank you.
Yeah.
Thank you.
So with that, it was great having this conversation with you. I learned a lot, and I love your perspective as well. It's quite different from a lot of other investors. And
I fear it is. Yeah.
No, which is good. I loved the advice that you said about honesty. I think that's quite important, and hopefully everyone that listens to this takes it on board as well.
Yeah, it's an interesting feature that actually I know you want to stop, but that as one gets older, so actually money becomes less important.
Yeah, and
integrity and looking after your clients and that sort of thing becomes more.
Yeah, no, I agree. Yeah, absolutely. Yeah. It's part of the maturing process.
Yes.
And I think also in general, people, the way society is set up and consumer society, a lot of value is attached to youth for some reason. It just is all around you, and less to,
I fail on that score.
Wisdom and the wisdom of older people and so on. And I think it's important to do that. I mean, I come from I have an Asian background, so that's instilled from childhood that you listen to elders and so on, and there's a lot of wisdom you get from people who've just been through life and have a lot more life experiences and just know what's what and see what's important in life.
Well, I'll keep quiet and over to you, Bilal.
Great. No, excellent. So that was great, Peter. Good luck for investing.
Thank you. Thank you. It's been good fun.
Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating, a nice comment, and let other people know about the show. We'd be super grateful. Finally, sign up for our free newsletter at macrohive.com/free. That's macrohive.com/free. We'll be back soon, so tune in then.